So this is chapter 6, lesson 1. For those wondering that, oh, there's a new chapter, there's been a few lessons that have come to my mind to give to you guys. Now that, at this point of the mentorship, as you come to this lesson, you're going to be a lot more seasoned. You're just going to be, you're essentially there, and this is going to be the next step. This is like the cream on top for those that are up to date, right? So, chapter 6, lesson 1, the OHLC and the OLHC. So, what is the OHLC? What is the OLHC? How to use the OHLC and the OLHC to increase accuracy and our read on price, to understand when they are reliable to also use. So, what is the OLHC? OLHC stands for open, low, high, close. This is the anatomy that we see and expect for a bullish candle to form. A bullish candle is most likely to open, then trade lower to create the low of that candle, and then expand and make the high, and then close above the opening of the candle near the high, right? What's the OHLC? The OHLC stands for open, high, low, close. This is the anatomy that we see and expect for a bearish candle to form. Notice the only difference between the OHLC and the OLHC is that the high and low are reversed. That's it. A bearish candle is most likely to open, trade higher, right, and create that high, and then trade lower and close beneath its open near its, low. This this should sound quite familiar if you've done chapter 3, right? From the daily and weekly profiling video. So why is it important to understand this? This is the key to my understanding of the market, right? I attribute most of my trading ability and success to the understanding of this concept. I get asked a lot, how do I get my read on the weekly commentaries so specific? This is the key, right? Everything that this mentorship has taught you is a setup for understanding this concept, understanding where price is, where it's likely to go, where did it come from, the arrays, how we move to and from arrays, right? Everything is setting up for this lesson essentially, right? If you could depict whether the next candle is likely to trade higher or lower, and then apply the understanding of the anatomy of the candle, that it goes, a bullish candle opens, goes lower, and then makes the high and then closes. If you can, apply the understanding of the anatomy of the candle, you can find endless opportunities in the market. This not only significantly aids your weekly and daily biases, but it also allows for many possible entry modes on an intraday basis as well. So from the previous slide, we understand that the anatomy of a bullish candle is that it opens, trades lower to make the low, which is the wick at the bottom of the candle. Look at the green candle, right? Then expands higher to create the high, which is the wick on the top, and then it closes above the opening near the high of the candle. And the opposite is true for a bearish candle. It opens, trades higher, makes the high, then expands lower, creating the low, and closes beneath the open near the low of the candle. Notice how there is no specific time frame I have mentioned in this. Notice how this is the anatomy of the bullish and bearish candle. It is the same across every single time frame. Look at this chart. You can't tell what chart these candles are for, right? Would you agree with the statement that if you knew that the next candle that is likely to print is likely to be bullish over bearish, then you would be able to then understand the way the candle should form, which should then allow you to trade it. Now, what do I mean by that last bit? Understand the way the candle should form to trade it. You know the anatomy of a candle from chapter 3, and we're just reinforcing it a bit more heavier now. The bullish candle on the left, consider that. That's an open, low, high, close candle. It opens, makes the low, then makes the high, then the close. What about if that was a daily candle? And you could expect that. You would expect the open at midnight, the Judas early on, and then you'll know that to look for longs and continuations higher. But if you didn't know that the next candle was likely to print higher, you would be unprepared going into that trading day, right? The next logical question to then ask is this. how do we anticipate the next candle to be bullish or bearish? And that's essentially what this lesson is going to be about. So the open, low, high, close. The open, low, high, close is the reference to how we expect a bullish candle to form from its open to its close. Now, majority of traders are completely unaware. They're absolutely oblivious to this, right? They do not consider how the candles form. They just see up candles, down candles. They don't even consider the candlesticks that are printing. They're looking at the overall trend, or the overall going down or higher. But what we're doing is we are getting a pinpoint accuracy. The next candle. Why do we care about 5 candles ago? I'm trying to trade the next candle, for example, on the daily, right? So the question is this: when can we expect the candles to start printing higher? And what can we expect when they do print higher? The next few slides will discuss when we can expect the candles to start printing bullish with the format of open, low, high, close, and what we can expect when this occurs. So when can we expect the candles to print higher? Using the image on the right, one may see just a piece of price action with some bullish and bearish candles at high and low, whatever it is, right? However, through the lens of open, low, high, close, we can actually identify when we can expect the candles to start printing higher. There's been a few times, well, many times on the Telegram group chat that we have, where I dictate the price action that's going on. And many of you have seen it, right? Where I say, from here, I'm expecting the candles to print higher, and the next candle to print higher, and the next higher, and so on. And this is how I do it, right? There is a discount fair value gap, right? This is a discount fair value gap. Now, this discount fair value gap could have been any array. It just happens to be a discount fair value gap for this example. And we see a bearish candle sweep into it, right? Following the bearish candle, we are then followed by a bullish candle. But this bullish candle swept the previous candle's low and moved higher. This is the prime context you should anticipate for an open, low, high, close delivery. Essentially, this is offset accumulation, right? Underneath every candle's low is sell stops. This is how the algorithm views it. Not just at your actual highs, every high and low of the candle has sell stops and buy stops. This is how the algorithm computes it, right? So in a bullish narrative, when in a discount of a range and price trades into a discount array and the next candle opens, trades lower, sweeping the previous candle low and moves higher, you're anticipating the next candle or candles to print higher in the form of, it should say open, low, high, close, right? And here, this should be open, low, high, close. This is the signature I hunt for in reversals. Treat every candle's high and low as a run on liquidity, as we've stated before. Notice how the next candles were bullish. You are anticipating an open, low, high, close delivery, meaning candles to print bullish or higher until a premium array is met with an open, high, low, close delivery following it, which is going to be explained in the next few slides, or until a run on buy side liquidity is achieved. In this case, you can see that from that discount fair value gap and the offset of open, low, high, close, we achieved the run on buy side liquidity in one rally, right? Notice how I removed the time frame on purpose, right? The annotations probably give it away that this is a weekly chart, but this phenomenon occurs across every single time frame. This would have gave you a greater insight of your next week's bias, as you could anticipate the candles to print higher on the weekly time frame due to the sweep of the candles low inside of a discount which offsets open, low, high close price delivery, right? This is a key of how I derive every weekly bias in your guys' weekly commentary. So continuing on, similar to the last slide, we again have a discount fair value gap outlined. We have a retracement into the fair value gap area followed by sideways price action. What we hunt here is the offset to the open, low, high, close delivery. We are inside a discount. Now we're waiting for that sweep on the previous candle's low and a move higher. then we can expect the next candles to follow the move higher, right? What we hunt for here is the offset to open low high close delivery as stated. So we are already expecting higher pricing and we have been delivered into the discount and we have found rejection away from the discount array. In this case, it was a fair value gap. Remember, it could be any one of the arrays, right? Or it could be a run on a sell side liquidity pool, such as a previous day's low, etc. What we hunt now is a candle to sweep the previous candle's low and close higher. From my experience, the best sweep for the candle to offset an open low high close delivery and an open high low close delivery is when it sweeps the previous candle's low into a fair value gap, essentially institutional order flow entry drill, right? It is not outlined here for the sake of simplicity, right? However, the candle labeled with sweep was into a fair value gap. From this candle's high to this candle's low, there's a fair value gap that exists. We see this candle sweep it and that expansion. This candle we can anticipate to open with an open low high close delivery, right? And we can expect that up until a level of buy side liquidity is achieved. From this moment, we can anticipate the next candle to trade higher in the form of open low high close, and this is a daily chart. Something as simple as just understanding this, right, and giving importance to every single candle and being conscious of everything. What candle is printing right now? What did the one before it do? Is the candle printing now, or the next candle that's likely to print in the form of an open low high close? This is what I want you guys to be conscious of, right? It's a very easy and effective way to dictate your next day's bias, your next weeks, months. You can even take it to the lower time frames, which is what we're going to discuss later on, right? You would anticipate the candles to print higher up until a higher time frame target, such as a premium array, any opposing array, or a buy side liquidity target is achieved. Another example of an open low high close delivery towards buy side liquidity. Notice the candle shown by the arrows, right? We are delivered into a discount array, being the fair value gap. Again, this time coupled with a bullish order block to the left of it. In this area, we wait for a sweep on the previous candle's low, regardless of the time frame is fractal. Notice I'm not saying previous week's low, previous day low. I'm saying the PCL, the previous candle's low, right? And this should offset the beginning of an open low high close delivery. This is essentially a buy program for the algorithm, right? So you see how we went into the fair value gap. This candle sweeps it and moves up higher. This candle, we're anticipating it to print higher in the form of open, low, high close up until this buy side liquidity pool. As we are delivering an open, low, high close delivery and imbalances are created as price moves away quickly, we can frame retracements into each imbalance created before continuing on with the open, low, high close delivery or the buy program. This was taught you guys as an institutional order flow entry drill, right? We're going to touch on a few examples at the end of this lesson, specifically on retracements to rebalance before continuing on. An important note to make as well, once an open low high close delivery is expected, for example, at the candle that's marked with the arrows, we anticipate the low of the previous candle to be respected and for price to reach and break the previous candle's high. We expect the next candle to be bullish. More specifically, we expect the next candle to open, create the low, then the high, and then close near the high that was made, right? Hence the name of the open, low, high close delivery. We anticipate the candles to print like this until a liquidity pool is achieved or an opposing array is met. Note that as we deliver bullish candles and we create an imbalance and we see like a down candle that's coming down, so we see a candle that's opposing the delivery, we expect it to go and rebalance the imbalance before continuing on with the open low high close delivery. The middle of the image is a good example of this actually, right? An imbalance was created where the label of fair value gap closes, we get a down candle printing which disrupts the open low high close delivery, right? Because it's a down candle. So we await for the move into the fair value gap and hunt confirmation for the open low high close delivery, to continue again, right? So here, when we go up higher, you see these down candles. We see that there's a fair value gap from here to here. When we see these candles, we're waiting for the down candles to retrace. And what we're waiting for is a candle like this. You see how now we're inside of the fair value gap. There's an order block here as well. You see how we sweep the previous candle's low and we move higher. You can expect this candle to then deliver in an open, low, high close, right? So the next slide is going to illustrate how pinnacle this concept is to day trading. Especially, we, essentially, we have the greatest probability odds in our favor seeing the market like this. From understanding this, you have an indescribable advantage of knowing if the next candle is likely to favor trading to one side over the other. And if you cannot sieve out the likelihood of the candle trading and favoring one side over the other, this is where you sit on your hands in the market. So how to implement the open, low, high, close. This is a daily chart for GBP USD and each day depicting 1 day of trading. How much of an advantage would it be to know whether the next candle should favor longs or shorts intraday? From understanding the open, low, high, close delivery and when and where we can expect it, we can increase our read on the buys for the next week or day significantly. As if the price action is pointing towards and favoring an open, low, high, close delivery, then we simply just need to find entry the next day to get long. Inside of a discount fair value gap and order block, we had a sweep on the previous candle's low and a close higher. Anticipate the next candle to now form in the format of an open, low, high, close, right? 1, 2, 3 candles down together make one bullish order block. Coupled with a fair value gap, this candle moves down into it, sweep of the previous candle's low and a close higher. We expect the next candle to trade higher, right? As well as favoring an open, low, high, close delivery, the next candle preferably should not breach the candle's low. Now, sometimes it does, but this doesn't invalidate the bias. It's just a sloppy price delivery, right? And we anticipate to break the previous candle's high. This gives us a range now to work in for the next day, where we can use chapter 3 teachings to navigate through the day. You see how if you cannot depict a clear open low high close or open high low close delivery, essentially you don't know if the candle's going up or down, if it's favoring one side or the other. You see how difficult day trading becomes because you won't know what side to expect your protraction and expansion, etc. If you cannot sieve this out, then sit on your hands till you can. Usually within the next few candles, notice how I didn't say days or weeks, I said candles, it is clear on which side is being favored, right? So the daily anatomy blended with the open, low, high, and close. Understanding that the next daily candle is likely to print bullish in the form of open, low, high, close, you can then use your understanding of daily profiling from chapter 3 to engage in the market for the next day. The image on the right is a depiction of the time of days that usually build each portion of the daily candle, right? This is the key for intraday. Before you even consider using Asian range and the session times, you have to know the likely delivery of price you are likely to see. Is it open, low, high close or open, high, low close, right? Chapter 4, Lesson 1 touches on this idea as the cleanest price deliveries are the candles following a move away from a premium or discount array. The reason for that is because it's clear to know whether it's open, high, low close or open, low, high close after displacement is achieved from a premium or discount array. The most common mistake smart money concept traders in general make, right? And perhaps some of you make this one as well, is you think that the kill zones are just magical times for trading and you see, you just gamble, is it going high or lower, and that this is the time to trade and, this is the move of the day essentially. Intraday trading is only clear once you can depict the likely delivery of the next daily candle. If you cannot depict that next daily candle, which direction do you know to trade into, right? Which side is going to be more favored over one side? That's the one that you want to participate in. If you cannot sieve it out, sit on your hands so you can. So from the image to the right, we can see that the move from the midnight open of the candle to the opposing end of the range, which is the low in this case, is usually done by Asia and or the London open kill zone. The expansion of the candle is then carried out by the remainder of the London open kill zone, plus the entire New York open kill zone, and London, that should say London closed kill zone, given that a high time frame PDRA was not hit for a New York midday reversal, right? So essentially, we're expecting New York continuation, given that New York didn't trade into a PD array. The move from the high of the candle to the close is usually the central bank's dealer's range, right? Because the central bank's dealer's range is usually that consolidation period for the rest of the day, and then followed by the Asian range as well. And that's usually what makes the close of the candle, right? View the anatomy of the candle as a power of three always, right? We want the open, low, high, close candle to open, trade lower, which is the manipulation, then expand higher, which is the distribution phase, right? We want this for every candle, regardless of the time frame. On the daily time frame, we know which likely time of days are used to cause the manipulation for us to then entertain trades in line with the distribution, which is usually and predominantly the New York session. Let me just reiterate how important this is. If you can sieve out the next day's bias from the previous slides, trade down into a discount array, sweep the previous candle, and that candle trades higher and closes higher, you know that the next candle is likely to open in this format: open, low, high, close, right? That's the daily candle. I've taught you guys how to hunt for the daily candle. Midnight open, protractionary phase, and you're looking for longs from around the low of the candle for the rest of the expansion for the day. If you can sieve this out, and this is the key to my success, you guys ask how to get accurate. It's being good at this specific skill here, right? So how to implement the open, low, high, close continued. Now continuing on from the previous two slides, we understood that the next daily candle was likely to be bullish in the form of open, low, high, close. And we understand at the time of days, we can expect each part of the daily candle to be made being the open, low, high, and close, right? We can then use intraday charts such as a 15-minute chart to wait for price action to align with the expansion that we consider. For example, we can wait on the 15-minute chart for that protractionary phase to the expansion. We are simply waiting for time to deliver the signatures we expect at specific times. True time and price theory. What do I mean by simply waiting for time to deliver the signatures? We know that at specific times there's going to be consolidation, the Asian range. We know at specific times it's going to be a Judas swing, midnight open to London, and then an expansionary phase, which is usually London open, after the opposing end is made, and going into New York. With the benefit of open, low, high, close, we know that we do not want to see the previous candle's low be taken out, and we want to see the previous candle's high be targeted. What this does is allow for us to have a greater gauge of the standard deviation measures of the CBDR. We know that the previous candle's low, in this case, the previous day's low, should remain intact. Therefore, a protraction move between 3 to 4, right, standard deviations, or I should say, 2 to 3 to 4 standard deviations makes more sense than 5 standard deviations, as that's the previous day's lows. This is my own blending of concepts that I studied and came up with as well, right? It's simple logic. Given an open, low, high, close delivery, we don't expect the previous candle's low to be traded to. This is the previous candle's low, and this is the previous candle's high, right? And this is the new day, this is midnight. We don't want to see price go to 45. That's getting very close to the low of the candle, right? It makes sense for it to be at 3, you can see that it's pretty bang on 3 or around 4, right? You see how now we've kind of, made a bound for our protraction. A lot of you guys said how many protraction, how many deviations do I expect it to go? 5, 6, Now you have a cap of where you expect the deviations to go to, right? You don't expect the previous candle's low to get taken, so any deviation that is very close to it or exceeds it, you eliminate. And from process of elimination, you have more reliable opposing ends of the range, right? It's a very neat trick. It's very, very neat. If you can understand this and apply this, and if you have questions, ask me. This can flip your entire trading on its head, right? Now, Asia to midnight is the accumulation period that we like to hunt for a daily power of 3. As we can see, Asia did consolidate, and then we expect the Judas swing after midnight to create the low of the open, low, high, close delivery in around London, right? The CBDR protraction helps to measure where to. And then we hunt the expansion. You can see a fair value gap entry in the New York Open kill zone outline, and also there's many optimal trade entries offered after protraction, right? Your entire mind going into this day is to look for longs, right? So this initial run higher shouldn't entertain you. What you're waiting for is this, right? This shouldn't phase you. Have you ever seen a candle forming? Look at a 3 minute candle form, right? Even if it's an up candle, sometimes it opens, trades a bit higher. It doesn't make a high or nothing. It just trades a bit higher, then it goes lower, makes the low, and then it trades even higher to make the high and then close. This is like that. It opens, trades a bit higher, but this isn't the high. It goes and makes the low, then the high, right? This is the move that you're expecting. Now, this should give you so much more confidence going into the next day because you know what you're looking for and you know whether it's going to be a favorable day or not, right? A lot of times we go in there saying, oh, the protraction, where's the protraction to? This now you have bounds. You don't expect the previous candle's low to get traded to, right? A protraction of this area makes sense. Once you see this and you see that displacement, your mind now is shifting to get in long, find an area to get in long. Any retracement to any array or optimal trade entry is a viable entry to get in. This is the entry that I was talking about in the text. A reminder to note is that avoid looking and jumping the gun on an open low high close delivery or open high low close delivery inside of a consolidation. No side is favored in a consolidation, hence why we stay away. If you cannot sieve out the likely delivery for the next day or the candle, if it's the week or the 4 hour, sit out until it is clear to you. It's that simple, right? So now that was the open low high close. Let's touch on the open high low close. So for the majority of the lesson, we've only considered the open low high close, which is the buy program. And everything we said, the opposite results in an open high low close delivery. A bearish candle opens, makes the high, then the low, then closes near the low, which is under the open. Where can we expect the open high low close delivery, which is a sell program, to start? We want to see at a premium array and all runs on significant levels such as that should say previous days. I don't know why it doesn't say that word. Such as previous days, weeks, months, highs, where offset distribution takes place, pairing smart money shorts with retail buy stops. Notice the candle marked by the arrows and what it done, right? It swept the previous candle's high into an array and moved lower. The weekly narrative was bearish and this candle was Wednesday's daily candle, right? A perfect reversal point for a reversal profile, given your weekly profile, Wednesday can reverse, midweek reversal. The sweep of the previous candle's high and move lower inside of the premium in a bearish context is what we hunt for a sell profile and to expect an open high-low close delivery until sell side liquidity is met. The next candle, as you can see, did indeed trade with an open high-low close delivery. Notice how the high didn't exceed the previous candle's high, right? This is what we expect in an open high-low close delivery, for the previous candle's high to remain intact and the lows to be traded through. The only time a high is expected to be broken in an open high-low close delivery is when retracement to an imbalance is on the table. Didn't expect the continuation of the delivery of price. The same as how we expect the low to stay intact of an open low high close delivery and the highs to remain, to be attacked. Again, fractal for every single time frame, right? Volume imbalance, and this was from your weekly commentary as well. This is not a cherry picked example. Monday, Tuesday traded higher. Wednesday, which is known for midweek reversals on a bearish week, sweeps the previous candle's high, trades lower. This candle you expect open, high, low, close, and then you can use, the daily or power of 3 to hunt short setups. So the daily anatomy blended with the open, high, low, close. Understanding that the next daily candle is likely to print bearish in the form of open, high, low, close, you can then use your understanding of daily profiling from chapter 3 to engage in the market the next day. The image on the right is a depiction of the time of days that usually build each portion of the daily candle. This is the key for intraday. Before you even consider using age and range and the session timings, again, you have to know the likely delivery of price you're likely to see. In this case, it's an open, high, low, close. Again, it's just like the bullish example. From the midnight open, you expect a Judah swing higher to make that opposing end of the range, which is usually the Asia which is usually Asia and the London Open that time. So midnight Asia, midnight London Open to make that Judas swing. And then the expansion of the candle from the high to the low is usually going to be the remaining of your London Open kill zone, your New York Open kill zone, and your London close kill zone. And then again, that move back into the range to close the candle for the day is usually going to be your CBDR, right? Implementing open high-low close delivery to intraday. Now, understanding that our next day is likely to be in the format of open high-low close, we can then use our understanding of the daily candle's anatomy alongside time of day for each portion of the candle to find a trade setup, right? Now you know that the daily candles are going to be bearish, and you know the anatomy of that candle. It's just about seeing time building the portion of the candle and getting in line with price. It's very simple once you can see it like this, right? From the midnight open, we are waiting for the move above the midnight opening price to place in the opposing end of the range. As you can see here, this was done inside the London Open kill zone. From there, you can fall back to any of the entry models that was taught to you in chapter 4. Notice the delivery of price after sweeping the buy side liquidity above Asia. What do you see? Pay attention, right? Pay attention to the open, high, low close of the candles. The concept is fractal, and once a run on liquidity is achieved on an intraday level and or a rejection of a PD array, you can expect the open high low close or the open low high close on an intraday level to also resume, right? You can do this even on a 1 minute chart, but I don't recommend that yet. From all my studying of the market, I've come to a conclusion that this is the crux of algorithmic delivery we seek. In certain times of days, when we run liquidity or reject off a high time frame PD array, this offsets a buy or sell program. It's either a buy or a sell program. Or there's another one, which is a liquidity generation. Essentially, it's a consolidation. Right, and then we get an offset of open high low close or open low high close delivery. If you had missed an entry off an array, you can apply the concept of open high low close or open low high close of the next candle to get in line, given that there is still a clear side being favored in the market. We'll now go over an example of that. So using the open high low close to get in, right? So as a developing trader, pinpoint accuracy off of arrays and the actual run on the turtle soup was what I was only after, and I kind of had discomfort in that approach as a new trader. Now I don't really, but some of you guys may have, you may not be comfortable shorting above that high, right? You may be like, well, I don't feel comfortable pressing, sell when price gets, above that high, and that's totally fine. I used to be like that as well. So consider the picture and the context of price. There was a clear turtle soup above the highs, and the next candle showed displacement away. This is where your mind should shift to open, high, low, close. Where is price right now? Where did it come from? Where are we likely to reprice or go? This is the name of the game in trading. Have that note. Where is price right now? Where did it come from? Where are we likely to reprice? Engrave this in your head, right? It's the name of the game in trading. Price came from displacing down after it ran buy side liquidity. Now, where is it likely to reprice? It's more likely to favor open high low close than open low high close from here, and we should target sell side liquidity. The next candle that is going to open, which is highlighted by the arrows, should open and close in an open high low close format. You can enter on the open of the candle with stop loss above the previous candle's high or anywhere that you have a conviction price should not trade to, such as the high of the range or any rebalanced area. Remember, if there is a fair value gap above the candle's high, then you can anticipate the candle's high to break to rebalance the fair value gap before continuing on with the open high low close delivery. So consider this before entry, right? Just to reiterate the point I was making here. We ran buy side liquidity and it's a bearish narrative, and you see this candle displaces lower. The next candle, do you expect it to trade higher or lower? Lower, in the format of open low high close. I don't know how many of you didn't see it like this before, but perhaps now you should see it. That candle, it should not exceed the previous candle's high if it's a true open low high close delivery. And look at the context of it. Does it make sense? We took buy stops and we displaced lower. The next candle, you can literally trade the open of that candle with a stop loss above this candle's high, or you could have put it above this high because you're not anticipating. Remember the bounds. You're not anticipating the high of an open high low close delivery to get traded to. We're expecting the candle's low to get traded through, right? And of course, you can target a sell side liquidity pool intraday. Recognize an imbalance with open high low close and open low high close. So from the last slide, we said that we consider open high low close delivery bearish candles until an objective such as an opposing array or liquidity is met. However, there will be disruptions of the delivery if imbalance is created. Notice how this is the same example showed as before, right? If we go back one, this one here is literally this one, right? So we had a buy side liquidity pool being purged and displaced, which offset open high low close delivery. Now, as the 3-bar swing low was made, right, which is this, right, it showed a willingness to retrace, right? 3-bar swing, we're anticipating now a retracement higher. This is where we sit on our hands, and we see that we have a liquidity void here, right? What we're hunting for now is the move into that imbalance, or it could be another opposing array. Now, what we're waiting for is confirmation that the open, high, low, close delivery is resuming. Inside the liquidity void, we get a nice bodied bearish candle afterwards, right? This is the confirmation that we're looking for. The best confirmation is if you get a 3-bar swing, right? So if you traded up into here, and then there was another candle that swept this candle's high, and then the next candle traded, lower, like this essentially, but here, the opposite. That's the best confirmation I look for. We can enter on the open of the next candle with stop loss somewhere safe. So I put it on somewhere that's rebalanced, exceeding this liquidity void, and we can target sell side liquidity. Do you see how this is way more forgiving, and it could be a lot more rewarding, and it's less tense, right? Sometimes people try to trade as you move into that liquidity void. Well, if you just wait for that candle to show rejection and that move away from it, and then you're anticipating that, okay, now there has been an offset of open high low close delivery, the next candle's open a trade there. Put your stop loss somewhere that should invalidate your narrative and target the liquidity that your bias is going towards. So here are your shorts, so look for sell side liquidity. Very simple. Before, and smart money traders, they think you can only enter here, and if you miss this candle, essentially you missed the move. You see how you have not missed the move, right? So example of an open low high close to get in line. So this is an example of implementing the open low high close to participate in a move higher intraday. We had a fair value gap, right? We had a fair value gap, and the next candle swept the previous candle's low inside of the fair value gap and a strong close higher. The next candle should print higher in the form of open, low, high close. And the target is the buy side liquidity pool again, right? Now, again, the entry would be on the open of the next candle with a safe stop and a reasonable target. Notice how after the run on buy side liquidity was achieved, the open, low, high close delivery finished. That's the end of a buy program. Buy stops delivered to. That's true algorithmic theory in action. Instead of entering at arrays as price moves into it, consider the confirmation of an open high low close or an open and low high close delivery away from the array or the run on liquidity, like I've shown you in these last few slides, right? So here, this candle, right, and we're bullish, and you see that it's clear consolidation to target. We expand and we displace higher, and we have two candles being a bullish order block and a fair value gap created here. You see how we trade down into it? This candle sweeps this previous candle's low and has a close higher. You can anticipate the next candle to be open, low, high, close. So you can enter on the open of the candle. I put my stop loss even safer, a bit under this candle's low, right? And you can target buy side liquidity, and you see how it did run to it. You see how more forgiving it is. Now, why enter on the open of the candle is maybe what some of you are thinking, right? Remember what we said before. The next candle, what do we expect in the open, low, high, close delivery? The previous candle's low to remain intact. So if we just enter long here with a stop loss underneath this candle somewhere, and it's a open, low, high, close delivery, and look at the context of it, it's in line with your bias and everything, you should be able to be a participant in this move higher, right? So that's the end of the lesson. It was quite a long one. So just to recap, the open, low, high, close delivery can be expected after a move into a discount, sweeping the previous candle's low and a candle close higher. You'll expect the next candle's low to remain intact and the high taken. The open, high, low close can be expected after a move into a premium with a sweep of a previous candle's high and a candle close lower. You'll expect the previous candle's high to remain intact and the low to be taken. If fair value gaps exist during the move to the draw on liquidity, then expect a retracement to rebalance before continuing on with the open high-low close or open low-high close delivery. It can be used to dictate the next month, week, day buys as well as entry mode as shown in the last slides from, letting the confirmation to be then entering on the open of the next candle. When a clear open low-high close or open low-high close delivery is expected for the next candle, you essentially hunt a power of 3 the next day. From the next candle's midnight opening, manipulation to the opposing end of the range, and then distribution for the expansion of the day. Any questions, ask me. Watch this one a few times. Now, how do you practice it? What I want you guys to do is this. See it on a daily, right? See on a daily when you trade into a PD array that's in line with your bias. See how it offsets this delivery. So look at your Euro USD chart. Look for in the past, this year has been a down year. Look for trade moves higher on the daily into a premium array and see how after you get rejection and a confirmation candle that the next candles offset an open high-low close delivery till sell side liquidity. And if you want to take it a step further, once you're good with that on the daily, the days that you're considering that the next candle's delivery should be an open high-low close, go on the midnight price and see how the candle is delivering to it and it's respecting the previous day's high and low. Remember, use the previous day's high and low as bounds for your open high-low close and open low-high close delivery and to kind of create a bound for where your protractionary move should be using the CBDR, right? So that's it for this video. Any questions, of course, ask me on Snapchat or the Telegram. And until next time, I'll see you guys in the next lesson of Chapter 6.